30 years of finding brands that capture a billion.
Hello and welcome to Bloomberg Quint. You are watching Q2 with BQ. We are joined by the CFO of Raymond, Mr. Sanjay Bahl. Mr. Bahl, thank you so much for speaking to Bloomberg Quint and taking out the time. Sir, if you could just brief us through the second quarter earnings as to how really did the earnings shape up, and if you could also tell us, did higher raw material cost, including higher prices of cotton, impact your margin this time?
Sure. So happy to take you through a quick summary of the excellent performance in quarter two for the group. Overall, our revenues grew by 16%, EBITDA growth by 35%, with EBITDA margin improvements coming in very strongly from 9.8% to 11.4%, and the underlying net profit grew by 56%. So from 41 crores, we went up to 63 crores in the quarter. So it's a very strong performance, and I must mention that last year we had a one-time gain of 19 crores. So which is why I'm referring to the underlying profit growth, which is really relevant as a comparable metric. So strong performance really underpinned by a good profitable growth across our business segments. So very quickly, if I can take you through this, our textile business grew by 15% in revenue, and in spite of the cost pressures, which I will come to in a minute, maintained its EBITDA margin. So there was a drop of just 50 basis points, though the impact on cost from the wool side was much higher. The wool prices increased by nearly 30 to 35% globally, and we have a single source of wool, which is Australia, and 90% of our purchases are from Australia. So there was a big impact on cost, but we were able to absorb this to a very large extent through a mix of measures, nominal price hike, wool cost optimization blends, and process efficiencies in our plants. So just about a 50 basis points impact on margins at a branded textile level. A branded apparel showed a strong growth of 15%, maintained the growth momentum, and maintained its margins at 3.2%. A garmenting business rebounded very strongly at 19% growth and a very strong improvement in EBITDA margins by nearly 400 basis points. Our B2B business, shirting business, grew by 17% and strong growth in EBITDA. Our engineering business grew 15% and EBITDA margin of 500 basis point improvements. Auto components remained the stellar performer, maintained its growth at 21% as well. So overall, a great performance during the quarter two. For the half year as well, we are happy to report that we've had a good first half of the year with growth at 11% and double-digit EBITDA margin.
Right. Sir, talking about talking about the apparel and the retail business, if you could share what did really impact the same-store sales growth, and if you could share the numbers here as to what are the factors of a slowing same-store sales growth.
Yeah, so let's first talk of the positives. So positive, of course, what I would like to mention in a branded textile business is that the domestic textile business has shown a significant volume growth. So volumes, which we measure in lakh meters, grew by nearly 2 lakh meters and showed a 14% growth. Our product innovations were on track in our branded textile business. We scaled up our institutional business strongly, and our network expansion remained ahead of our plans. So we added our mini CRS, which is our innovation in the retail store plans that we have. That has now at a level of 139 stores, which are penetrating deep into tier 4 to tier 6 towns. And Branded textile is also now moving from a fabric-led growth to also getting into services. So we are providing new services through our tailoring hubs, and that is going to fuel the growth for future as well. So overall, good positives on all our strategic plans and initiatives within branded textile. The headwinds for branded textile, as I mentioned, were largely on cost. And of course, the downside this year is the number of wedding days are significantly lesser than what we saw last year. So, while the first half of the year was largely barren in terms of wedding days, the second half, last quarter of the year is where we see upside coming in and a strong wedding season in quarter four.
Okay.
Coming to branded apparel, we've seen growth across all our 4 power brands. Our ethnic business, which we have recently started, showed strong growth and a great response from our trade channel partners on the product line that we have created. So that is a business that we feel we will be able to scale up in the future. We have plans for addition of nearly 41 franchise stores in the ethnic business. We already have 5 franchise stores in place right now. So there are clear plans to scale this business up. There is a great opportunity which we feel that we can unlock here. And we've been working over the past 1 year on this. We have launched a new brand in the value segment in apparel called Next Look. And that has also received a great response. Total sales are around 25 crores for Next Look as of now in the quarter. But clearly the opportunity is big here. Okay. Same-store sales growth was impacted. Footfalls were impacted at the store level. So we had a same-store sales growth which was negative for around 2.5% within the EBO network that we have, but largely compensated by the significant growth that we saw in the MBO channel, which was upwards of 50%.
Okay. And sir, talking about the e-commerce segment, did that impact the overall growth in terms of revenues? Because we gather that there was a lot of discounting in the marketplace which happened. So what was the trend? And more importantly, in the second half, do you expect better realizations as discount narrow? And as you were telling that the wedding season and festive season would probably aid the overall revenue and growth picture?
So I think the deep discounting that we see in the e-commerce trade, I think is, we hope that obviously there is more commercial sense that prevails, but that is something that we expect will continue. The online pressures will be there. However, we remain confident about the brands and our strategy and the brand positioning that we have. So we pulled in spite of all the pressures on the e-commerce side, we still pulled in a 15%, maintained our growth momentum in all our power brands and the extensions that I spoke to you about. So we are confident that against the backdrop of a festive season ahead and the wedding season ahead, we should have, and historically we've always had a better second half than the first half of the year. So we are certainly hopeful that we will be able to, with the full wardrobe solution offerings and the innovations that we are doing within the brands of Color Plus and Park Avenue, we should be able to retain our customer loyalty and maintain our growth. So that is positive for us.
But sir, I was just looking at the cost towards development of property, and you have spent almost 7.5 crores here in the second quarter. If you could just give us an idea as to how really are the plans on the real estate front and on the Thale land moving, and also are you in talks to sell some land parcels at Thane and try and monetize it in the short term?
Okay, so let me reiterate what our strategic focus is on Thane land. We've stated that our strategic intent is really to monetize the land asset that we have, and we plan to do it in 2 ways. One is to try and sell smaller parcels of land. Two is to monetize the land by developing a small parcel of land, which is 20 acres, which the board has approved. We have put together, the real estate team has put together its development plans. They are in place now. Okay. However, we are awaiting a regulatory approval before we can go ahead and launch the project. Okay. Formally launch the project. So I think we are hopeful that, while I cannot put a timeline to it, we are hopeful that certainly in the second half of the year, we should be in a position to launch our development project that we have announced. And efforts to sell smaller parcels of the land continues as we speak.
Okay. Thank you, Mr. Bahl. We leave it at that, and all the best for the coming quarters. So that was the management of Raymond talking about the Thane land, how they plan to monetize 20 acres of land parcel once the approvals are through. And more importantly, they expect the second half to be slightly better than the first half, given the fact that there are more wedding days, as well as, there are festive seasons, which could aid the overall growth in the textile segment.
Well, hello and welcome. This is Bloomberg Quint earnings special. Basically, Shriram Transport Finance has reported 22% growth in net profit, with the asset quality ratio coming down marginally on a sequential basis. But what is the growth outlook going ahead given the current environment? Let's bring in Umesh Revankar, the MD and CEO at Shriram Transport Finance. Mr. Revankar, thank you very much for joining us. Whilst the traction in the first half of the year has been strong, do below normal monsoons, the moderating growth as far as auto and tractor sales are concerned, and high inventory levels point to a slowdown in the second half of the year? I remember during our previous conversation, you had said that you will pare growth to about 15 to 18% from the earlier guided 18 to 20% if the current operating environment for MDFCs continues to remain tough. So what is the stance on growth now?
See, as of now, the reading is that the demand is quite good, because we are in the between festive time, and also there is a harvesting period. November and December are typically harvesting period where the what called summer crop move and get converted into cash for the rural people. So there will be definitely a consumption drive. So I think demand-wise, it looks quite good, and we are able to raise raise resources. Right, currently, our public issue of NCD is on, and against the base size of 300 crores, we are already oversubscribed 2 times. So that should help us. So we are almost ready to meet the demand, and our growth rate should be around 20% for the year, is what I believe.
But do you see any kind of a large shift in your funding profile, probably a move towards retail FDs and a lower share of mutual funds as far as the overall funding mix is concerned?
We do have some pipeline on securitization and the assignment. Both there are some pipeline that is going on. So we would be definitely able to raise money from the banks also, so apart from the retail. So I don't really see a challenge. There would be definitely some increase in the cost, maybe around 100 basis points. But our customer being retail and small ticket and urban, semi-urban and rural, we would be able to pass it on. So we should not have pressure on the margin perspective.
Right. So what was the quantum of the loan sell downs that you've done in Q2, and what is the target for Q3?
Q2, it was a little lesser than the Q1, but we did around 1,500 crores. So we should be able to do around 3,000 crores for the Q3. So there are some pipeline, and it can be larger also.
All right. So you were talking about margins, and I understand that on one hand you have increase in cost of funds, and also your share of new CV financing, which is a relatively lower yielding. So the share of that in your portfolio mix is increasing. On the other hand, will higher securitization be able to aid steady margins? I mean, how much of these costs can you pass on to customers without it having to impact demand?
Our focus is always on used vehicle. As far as our used vehicle individual customer is concerned, we will be able to pass it on. Probably our new vehicle lending may slow down because of the increase in cost, and we do not want to sacrifice our margin. So to that extent, we would be able to maintain our net interest margin. But growth rate, if you are not lending to new vehicle, it may come down, but it will be very marginal decrease. It will not have any impact on overall business growth.
Okay. So then what was your exposure to the flood affected areas in Kerala, and have you used any disbursements? What are the kind of losses that you booked in Q2, and what could you see in the future quarters? Kerala
is around 3 to 4% of the total AUM. That's around 3,500 crores is the AUM in Kerala. And the most impacted districts are 4 districts of Kerala. There, yes, we did see some jump in bucket movement for 1 to 2, 2 to 3, like that. And we did take higher provision in Kerala, because we expect the situation to be normalized in maybe 3 to 4 months. So we have taken the very conservatively higher provision in the last quarter.
Right. So if at all there come any, but what kind of possible regulations on ALM mismatches could the RBI come out with, and how will that impact Shriram Transport Finance?
See, we do always maintain more than a month of future liability as a cash. So we may not have any impact on introduction of LCR. At the same time, ALM, we are positive on all the buckets, so we don't have any mismatch.
All right, Mr. Revankar, thank you very much for joining us here on Bloomberg Quint. Appreciate your time. That's the management saying the demand trends continue to remain strong, and 20% growth in AUM for FY19 is still doable. But that's all that we have on this earnings special. Thanks for watching. Stay tuned into Bloomberg Quint.